Hi, Lee Phillips here again. I want to talk to you about what I'm going to say are traps in real estate depreciation. Real estate is a tax shelter, and a lot of people don't realize that. They know that people get rich when they have real estate. Yeah, the real estate appreciates and the tenant pays the rents, and I understand all of that. But what a lot of people don't understand is the tax aspects of real estate and what a great tax shelter it is for you. You get to depreciate the real estate, which creates a loss. Now, it's a passive loss. You can't use it to offset your ordinary income, but it offsets the rents that you collect. So effectively, you're getting money from this thing called real estate, and you're not paying much, if any, tax on it. I know people who have hundreds of rental units and pay zero in tax. So it's a tax shelter. Part of that is depreciation. Let's talk about the depreciation and the traps in depreciation for 2 seconds. First of all, you buy the place, you buy it for $500,000. And you start to depreciate and you depreciate all $500,000. No. You can't do that. You can't depreciate the land value. Well, how do you know what the land value is? A lot of times the accountant will just depreciate the entire $500,000. Sometimes they'll say, well, it's about 15% of the value of the $500,000, so we'll take that out and then we'll depreciate the $375 or whatever it is. And no, you can't do that either. The IRS will come back, and the way they're going to do it is they're going to look at the county records. You get taxed on this land, on this piece of real estate. And the county record will always break out the real estate value versus the improvements value, is what they call it. So you're going to have two numbers on your property tax return or your property tax statement. And yeah, those two numbers only add up to $350,000. Well, yeah, that's true. But you can easily figure out the percentage of that $350,000 that's allocated to the real estate and the percentage of that $350,000 that's allocated to the improvements. You get to depreciate the improvements, not the land, not the real estate. So you take the same percentage, you apply it to your $500,000 purchase price, you now have the land cost and the improvements cost. You can depreciate the improvements. So the first trap is you got to take out the land before you start to depreciate. It chokes me all up. And I understand that in some of the homeowners associations, they own the land. Well, it gets snaky, but basically you have to be able to show the IRS you've taken out the land value and you're not depreciating that. Next trap. Is it commercial real estate or is it residential real estate? And you buy a 10-unit apartment building, your accountant's going to say, oh, commercial, because your insurance is a commercial policy. Everything else you've got is a commercial policy on that land. So you're going to say, well, I need to depreciate it as a commercial property. The answer is no. That's a residential property. How do you tell what's residential and what's commercial? Because it makes a difference. Commercial is 39-year depreciation. Residential is 27.5-year depreciation. So you're getting more of a deduction in a smaller amount of time with the residential. The IRS looks at it and says, well, does 80% or more of the rental income, the income that you get from this property, is it due to dwelling units? A dwelling unit's a place where a guy lives. If 80% of it is dwelling unit income, then it's considered residential. I don't care if it's a 100-unit apartment. It's considered residential because more than 80% of the income is from dwelling units, the rent from dwelling units. Now, there is one catch on that, and that is the leases have to be, on average, more than 30 days. And you can't get more, you have to get at least 50% of your income from leases that are more than 30 days. If your leases aren't more than 30 days, then basically you have a commercial piece of property. So that means all your short-term rentals, your Airbnbs, that sort of stuff, they're all commercial properties, 39 years. They're not residential properties. And the accountants will often screw that up. They'll look at it and say, oh, okay, it's a single-family house in the middle of a neighborhood. It's residential. Well, it's not residential because you're Airbnb-ing it. And your income comes from these short-term leases that are less than 30 days on average. So you've got to look at that. I do have a cold. I've got a mask on the microphone. You're not going to catch anything. You'll be okay, all right? But you need to worry about these traps in depreciation. Those are two of the biggest. Did I get the land value out? And is it residential or is it commercial? And I do actually an hour discussion on this, and we go through it in great detail and a lot of other stuff. If you're interested in a copy of that, send an email to info, I-N-F-O, at legalease, legalees.com, info at legalease.com, and ask for the expanded discussion on depreciation of real estate rental. But that's the basics. Go for it. A lot of the strategies are ways that we can accelerate that depreciation. We do it through cost segregations. We do it through a bunch of stuff. But if I can get that 27 and a half years, if I can get most of it up front, then I get a big tax deduction now. I can carry it forward, and it just eats up all of my income that I get off the piece of real estate. Real estate's an excellent tax shelter. Now, don't forget to subscribe, because we keep doing stuff like this and asset protection and all sorts of stuff, and even give us a thumbs up and like us every once in a while. We're likable people, honest. So this is Lee Phillips talking about traps in real estate depreciation.